叫開 WhatsApp。
Hey, what's up, everybody? Welcome to Huobi Research, the weekly market chat. Today, we are going to cover a lot of exciting news, and also we have some new findings about our developing indicators. And that's why our topic is the leading indicator of everything. It sounds super cool, right? But uh,
Yep,
we'll
yep.
we'll delve into the indicator later. We'll delve into the indicator later. Let me give you an overview of today's topics. And first of all, we're going to have a overview of the current market. I'll look into the Bitcoin and also Ethereum chart. We'll go through some technical analysis with you guys, and then we are going to talk about the cautious. We have to be cautious about the current bullish pump, and we will talk about the reason why we have to stay cautious about it. After that, we're going to talk about the Fed balance sheet. As we already mentioned last week, we are developing some powerful indicators tracking the capital inflow and also outflow of the Fed balance sheet. And that's where we are going to explain to you guys so that you can learn more about the the method to track the capital of the balance sheet so that you know what's happening, the liquidity flow in the market. And after that, we are going to we're going to discuss the Ethereum fork. We're all very paying a lot of attention right now because the Ethereum fork is supposed to merge. No, I mean the Ethereum is going to merge in late September if there's no delay. And then what we worry about now is that there will be Ethereum fork, and developers need to take sides because there will be Ethereum 1, which is based on proof of work, and there's the upgraded Ethereum 2, which is based on proof of work, proof of stake, and that's we are going to discuss the outcome of the merge and also the fork that's happening. And after that, we're going to introduce our X research style backed by Huobi Research, and we are going to publish a lot of powerful and also nutritious, insightful research papers so that you guys can stay updated to the market. And last but not least, we have the candy drop. Make sure you watch till the end so that you know how to win the candy drop. You can win some award from trading on Huobi app. So make sure if you are not live on Huobi app now, open your Huobi app, and then watch this weekly market chat on the Huobi app live. And let's get started without further ado. And we we are going to introduce some of our powerful leading indicators that we are currently building. As you can see from the left hand side, we have the Bitcoin average versus our leading indicator, and also the below we have the S&P, the SPX average with our leading indicator, and that's we are going to talk about, and we are going to delve into the mechanisms and also the logic and also the methodology that we use to build the indicators later on in the middle of this session. And then on the right hand side, we have the global money supply versus Bitcoin market cap, the year of change market cap. And this is a very powerful indicator that we are building because it signals the bottom of previous cycles, and that's why we think it can tell us, the possibility of another bottom formation, and that's where we are paying a lot of attention to this indicator. We are very excited to announce this and also to introduce these powerful indicators with you guys. And let's take a view of the current market. Monday dump. We're not very happy to see this actually. So let's move on to our trading rail. So we are going to look at the Bitcoin first. So wait a minute. Let me switch it to Bitcoin. Wait a second. So right now, as we talked about last week, Bitcoin, just broke out of the trading range, and then it was now trading at 22K. It's now rejected by the anchored VWAP. The anchored VWAP we used to date back to this previous high, and then we can clearly see the rejection of the price from around 24K, and then we are seeing some downward movement, and also if it gets back to the trading range, and that's why, and then we think if it gets back to the trading range, it probably had a failed accumulation, as we talked about in the last weekly market chat, and that's not very bullish to us, and we are paying a lot of attention to its development right now. So the RSI is standing at 40, and then it's going downward, right? And then currently we are seeing we are going to see some support as I drawn the line on the trading range line 22K. We're going to see some support there. Hopefully we'll have a bounce at, and then let's see how it develops, because previously, as we have discussed earlier in the last episode, we were actually seeing an accumulation pattern here, as I have mentioned in the previous section. According to the Wyckoff accumulation pattern, make sure you Google it, Wyckoff accumulation pattern, and then it played out. After that, it broke the trend line, and then however, it came back to the trading range, which is not very bullish, probably because the bearish macroeconomic environment right now, and that's we are trading now at 22K, and it's standing at, if we look at the 4-hour chart, it's standing at 100 moving average, and let's look at the Ethereum chart, and the Ethereum is now trading at 1600, 1K600, and then after the bullish pump on 26th of July all the way up to 28th of July, and then we saw a lot of resistance and supply up there. Supply stepped in and then pushed the price back to 1.5K, and then we are now trading at 1.5K. Now it's not very bullish, because as we can see, there is a RSI divergence here. Let me draw the line here. The RSI is showing a lower high, while the Ethereum chart is making a high, and that's why we're thinking that this divergence is not very healthy to the bullish development of ETH, and we're paying a lot of attention to its development as it approaches September, and we will have a merge there, and the merge will probably we'll see a lot of volatility around the period of merging. And we are going to talk about the Ethereum merge and also the fork later in the later section. So currently the market is bearish. Monday dump a little bit bearish, and let's see the price movement 1 to 2 days later to decide to have a more complete and comprehensive picture of the overall market development. But it's better to look at macroeconomics apart from doing the technical analysis, because technical analysis is just it's just giving us some reference for getting a better entry. But in order to predict and also to determine the trend, is it uptrend or downtrend? That's the first thing before we go into any trade, and that's why we are going to pay a lot of effort on studying studying the background of the uptrend or downtrend reasoning, and that's why we are going to, let me switch back to, and that's where we are going to, let me get back to the new share. Wait a minute. Okay.
Yeah, cool. So I think the technical analysis is very great. Like, it gives our audience like takeaways to how to deal with the market. Where's the buying pressure, selling pressure, what are support and stuff, and have an introduction of the macro analysis. So what do you think, Johnny?
Oh yeah. Right now, let's get back to the Ethereum chart. We are, as I mentioned, we are seeing some supply there, and the resistance came in, and maybe Dave, you can talk about the current market pump that we have to be cautious about.
Yeah, so certainly. So we have a market capitalization of BTC to ETH ratio. So and no investment advice. But when you're trading at a range, at a premium or at a swing, so you better look at like what the assets or equities or tokens or coins are outperforming or underperforming. So if they're outperforming generally, so we also have to look at, are they overbought or are they oversold? So, compared to BTC, to ETH, they should have a relative, market capitalization of, sort of like equivalent ratio or stuff. So when we see that, on the right chart, like ETH to BTC, Ethereum to Bitcoin, that it hits up with a the purple one is probably the Kaplan channel, and the sort of like the blue underlying the channel is probably the Bollinger band. So if we look at there are like overbought situation where the candles are pushing off the range, we probably see a overbought condition that if it's so bullish, it's too bullish, or if should be cautiously bullish on the BTC or if the BTC ratio. So back in the chart, I know and I think that it's great to have channels on the upper channels, lower channels, white copper and stuff. But it's also important to see that if we have the the sling line at the upper of the candle, like if you look at the left chart, you can see that there's a green candle, there is a bullish candle, and then we have the the sling lines at the upper part of the candle body. So we have this situation, this phenomenon on the slim lines for a consecutive like of 4 days and 5 days. So this is very should be cautious bullish or should be cautious. So a little bit bullish for the overweek or in the week, but like very bearish if we see like Monday dump or Sunday dump or the recent dump. So when we look at the the other chart, so like we have the Ethereum number of address saying the exchanges. It probably we can see that we have a spike of these active or these addresses, and what they tell us is like previously, I mean historically, we have like three peaks, probably like 2018, 2000 late 2018, early 2018, 2021, like sort of like 2021 to 2022 and stuff. You also see that there is a spike of active address. I mean, total number of active addresses. So this is concerning our chart. So this is probably indicating that maybe too many retails or too many market players are participating as a sell so like buying Ethereum stuff. So this is like overboard or like euphoria condition. I'm not saying it's a complete complacent market. I'm just saying there is temporary overhyped condition. So what do you think about that, Johnny?
Yeah, we have to pay a lot of attention to this page. As we have shown the number of ETH addresses sending to exchanges, we have to think about why this number showed up, right? And I think it's very obvious. The reason that the number of these addresses sending to the exchanges are mainly, they are suppliers of ETH. They have to, they are going to distribute their ETH, and that's why they send their tokens to exchanges. They don't sell, they don't send their ETH to exchange for other purposes, right? Other than selling, and that's why we have observed. If as Dave just mentioned, if we look back in 2018, we see the previous high there, the top there around 1,000, and then we had a peak here. We had a peak there. The number of addresses sending to exchanges peaked just at the top of the Ethereum price at 2008 at the all-time high there, and the reason is that people send their Ethereum to exchanges to sell the tokens. And that's why it's very worrying right now that we see another peak here, all-time high. We're very worried that these addresses sending ETH to the exchanges are going to dump on the market. And that's why we have to be very cautious that if these people really sell their Ethereum on exchanges, are there any potential buyers stepping in to support the selling pressure? And that's what we need to think about. Are there any buyers that are bullish on the Ethereum, and then are they going to absorb this enormous selling amount here? And that's what we have to be really cautious about, right, Dave?
Certainly, certainly. So like, the number of active addresses sending hours sold like to exchanges to be sold or more retailers are participating or in buying with the centralized exchanges. This is concerning. So like, should we jump on to the Fed balance sheet? The Fed trader section.
Yeah, yeah, sure. Yeah.
So like, I think Johnny made a very good point that technical analysis is great. It solves out the buying selling point technical strategies, but we also have to take a great look, deep look at the macroeconomics. So so looking at this chart, it may looks complicated, but we just want to make everything clear that macroeconomics can be simple, can be easy, can be convenient on plotting charts that we are gonna break down with how to sort of like ways to time the macroeconomics with Federal Reserve sort of like yield curve and also the market yields with liquidity withdrawing. It means that taking out the liquidity for the market. So let's jump to sort of like this the breakdown of the those fancy words. So probably the looking at the first at the left chart, we can see that the red line is sort of like market yield of on U.S. Treasury security. So like what is like market yield on U.S. Treasury security is basically the the market percentage that these securities are promised to give out to the investors when the investors hold a certain period of time of these securities of these bonds or the so-called U.S. Treasury bills. So like the blue line is sort of like overnight reverse repurchasement agreement. So award rate. So what I want to break down to the audience is like this is basically the the yield promised by Federal Reserve. So the blue line is Federal Reserve yield, so they promise, and the red line is how the market reacts or market pre-reacts to the yield hikes. So before we can look at the chart, that left chart, before the market or before the rate hike on in accordance with the blue line. So we can see that the red line, that means the market yield already pre-reacts with the yield high policy. So in this period, when the red line is above than the blue line, it means that the market thinks that the yield is going to increase. So at this point, when the red is above the blue, we can see that the market is having a down period. So after that, when the blue line is higher than the red line, basically the Federal Reserve yield is higher than the market promise yield. So we probably have a relief rally, a relaxation because the narrative or because the story or because the catalyst just fulfill, this is sort of the market expectation, the trade, then the expectation comes out as a truth, then the market just leaves. So it's basically sort of this relationship that tells us how to have an advantage or how to analyze the market in a macro way. So what do you think about these components or the macro analysis, Johnny?
Yeah, I want to, clarify some terms here because I think there will be some, new audience to our market chat, and some of you might not have watched our last episode. We explained the definition of repo and also the market yield and also other balance sheet terms. And today, no, please don't worry about it because I'm going to explain once again. The repo is actually a program adopted by the Federal Reserve to attract, or we can say to withdraw liquidity from the market. And this is a program to, make liquidity with that. It's actually a reverse purchase agreement.
Hey, bro,
To
can you hear me, bro?
sell
Hey, John, can you hear me?
with the so that's a very powerful program. You know, to attract, to withdraw liquidity from the market in order to contract the monetary policy to curb reduce the size of the balance sheet in the coming months and in the coming in the coming and that's why we are seeing a lot of reverse repurchase to get out of the market. And so maybe we can get to the other page, and we have to, let's go through other important factors that affect reserve balances of depository institutions. So the first thing, we have currency in circulation that's standing at 2.2 trillion. And then the second one that's also important is the reverse repurchasement agreement. I've already explained the definition of this one. The Fed wants the market to withdraw liquidity and park with the Fed. And then the other, the one below is deposit with FR banks other than reserve balances. And we have the one that we have to pay attention is the U.S. Treasury General Account, because this account is actually the checking balance of the government. For example, when the government wants to send out stimulus check, it's actually the stimulus check are sent from this account. So this account is actually used for government expenditure and also other revenue, for example, tax revenue. So this is very useful for us to analyze the capital inflow and also outflow of the government. If we track the data carefully and also consistently, we can predict the possibility of the market from reacting from the changes in the TGA account, the Treasury General account, because just imagine that if the government has more expenditure to spend, for example, the government has a lot of budget to purchase and also to inject liquidity into the market. How do we know that, right? We have to check the balances of TGA to see if the account balance is decreasing or increasing. If TGA is increasing, that means that the Treasury is actually selling securities into the market, and that's why it's getting cash in return. On the other hand, there are also some other factors which do not affect the market. For example, tax, it goes into this account as well. And then if this account decreases, which means that it has some fiscal expenses. For example, purchase some securities from banks, and then this account balance will decrease because it pays cash to banks in return for some securities. Right? And then that's why we have to pay attention to these particular balances of the Federal Reserve. And these balances can actually be acquired on the website of Federal Reserve. We are actually building some powerful indicators tracking these data. We are building some indicator to track the liquidity flow of the Federal Reserve, so that we know what's happening in the market. We can predict that if the market is going to pump, or we're seeing liquidity being withdrawn from the market as a result of the increase of TGA account or the increase of the reverse repurchasement agreements. Because as I mentioned, if these the reverse repurchasement agreements, if this increases a lot, just like what we see here from July 28th, we have seen 1.3 trillion increase, and that's a very big number, right? Trillion. And then we are expecting that the liquidity is being withdrawn from the market to the Federal Reserve, and then we are expecting a withdrawal of liquidity from the market. That's why we're seeing a downward pressure into the market, and we are going to evaluate if there's evaluate if there's supportive demand stepping in to support the market or not. And these are some factors that we are paying a lot of attention to, because if there are some big changes in these accounts, these balances, and the market will react to it. Right? But there is a time period which the market receives the data. It actually takes time for the market to move from the Fed balances to the market. There's actually a lag time frame. There's actually a lag, probably few days, 1 week or 2 weeks, and then we are going to delve into the relationship between these balances with the market, especially the risky market, equity markets that we are very interested in. And yeah, probably in the next week we are going to talk in details about the indicators that we are building, so that you guys can also learn how to track these data more efficiently, and so that you can keep yourself updated to the market, and you can better position yourself before market becomes very volatile and make some big changes. And yeah, and that's basically what we are seeing here. So maybe we can talk about, let's take an example of the treasury general account, as I just mentioned. That maybe Dave, can you explain to our audience that what the general account does, and we are seeing some relationship here. Maybe we can clarify the relationship, the correlation here, so that our audience know what's happening with S&P and also the TGA.
Cool. So I really like your point that we have to track on what are the balances, what are the numbers that the Federal Reserve is picking or is changing to sort of like affecting to the market. I'm not saying a manipulation, because manipulation is sort of like subjective. I'm just saying there is a correlation between the Federal Reserve liquidity, with the market. So no investment advice. So by looking at this chart, basically we can see that there's a red line, which is basically the S&P 500, which is classified as a relatively riskier asset compared to like traditionally like bonds, the treasuries, the treasury equities and stuff. So like when we look at a blue line, it's basically the TGA account. So the TGA account is basically the US Treasury account. So the US Treasury account is sort of like how the government, or how many treasuries, I mean the amount of money the US government is holding as a treasury security. Basically they have that the Federal Reserve just release the money or release liquidity, and the liquidity goes into the US government bonds or treasury bills for 1 month, like 2 months, or 1 year, like 30 years, 10 years, treasury bills or treasury bonds. So or US government bills. So basically they are more or less like the same. So in this TGA account, when they have more treasuries into their accounts, basically it signals a in inverse and leading indicator. So when you see the blue line hitting high, basically at the sort of like a 1 week to 2 week time frame, is act as a leading indicator to for a S&P 500 lower lower the expectation of the where S&P is going. So S&P is basically going down. If we see 1 or 2 weeks ago that TGA is rising. So no, on the other hand, if we see the TGA is lowering down, is decreasing, or is falling down, so basically we'll expect in a week or two that S&P 500 may have the probability to increase or have a relief rally or turn bullish or stuff in the interweek or intra-week time frame. So basically it acts as a sort of like leading but inverse indicator. So it also has to combine with our indicators just how Johnny described with you that the technical analysis and also a lot of like white curve, the wedge stuff, and also a lot of stuff. So basically, if we look at TGA, is like one of the most juicy ingredients of all of the content of the Federal Reserve balance sheet. We also have a bunch of leading indicators building, not just from the TGA, but also combines the ingredients or the numbers of TGA with also our Federal Reserve balance sheet factors. So what do you think about this Federal Reserve, balance sheets, numbers, and analysis, Johnny?
Yeah, definitely. This is one of the important factors that we have to consider. Except the TGA, we also need to consider the reverse repurchasement agreement and also to pay attention to the market sentiment. By there are also a lot of other factors which can affect the equity market. Uh, this is just giving us a reference or a piece of information that the market will probably have some upward or downward pressure to develop in the coming future because we're seeing a change in we're seeing a change in factor as we are seeing here a negative and inverse correlation between TGA and also SPX is being observed here. But it doesn't mean that in the future, if TGA account decreases and then SPX will go up. It's not that. The logic is that the probability increases because it respects the historical data, right? And we have to take account and we have to take account a lot of other important factors. For example, as I just mentioned, some market sentiment indicators. We have to pay attention to are there any upcoming news which may affect the demand and also supply of the market, and that's why we are building some more indicators so that we can grasp a more comprehensive picture of the overall market, and that's what we want to deliver later. And let's move on to another very powerful indicator that we are now developing. And we are actually seeing a very interesting thing here with the global money supply year-of-year change chart with Bitcoin return year-of-year change. And probably, Dave, you can explain to our audience so that they can, better understand what this chart is showing and what they can, learn from the chart.
Cool. So basically, this chart is telling the audience and telling us that in the macro rate or combined with macro analysis, where is the bottom, in a year or two. So like in a monthly time frame, that we also have that to be built on a trading wheel. So it's also free, if you have a trading wheel account. No, by the way, I'm not associated with any business relationship with trading wheels. So what I want to tell the audience is that the upper graph, the gray chart is for like the global money supply year-over-year change. So the downward, in the gray chart is the candlestick, pattern, or the chart is basically the BTC return year-over-year change. So with the candle chart as the BTC chart, the from like a 2013 to now 2022. So basically, what we define as a relationship is that we try to think about if there is sort of like any year-over-year, delta or year-over-year change that is associated with global money supply and Bitcoin return. So basically, we derive, from the gray chart, which seems to have, sort of like a close relationship that if it, like the global money supply bottomed out, we sort of like see a, BTC return as, like year-over-year change, they also bottom out. But more importantly is that if we look at the RSI monthly indicator, RSI, that's basically the purple chart, with as a purple indicator, we can tend to see that there is a markup of the black color. We see a bottom of February 2015, and there is when we see another bottom when the RSI hits the relative bottom. So we can also see when the RSI hits a similar level of the lower point, we can see there is a January 2019 macro bottom of the basically the as a leading indicator for the year-over-year change. So when we look at that, we also see the Bitcoin return year-over-year change associated with February 2015 bomb and January 2019 macro bomb. So this indicator combines with the macro analysis and also the Bitcoin analysis cryptocurrencies versus the macro analysis with also technical indicators like RSI. So right now we can see if you say Bitcoin is sort of like an inflation hedge, probably now because like what we see gold if everybody said, if somebody told you that gold is an inflation hedge, but why do we always see that gold is always fluctuating and we always have sort of like higher or lower volatility, of gold or XAU compared to the S&P 500? So this is basically telling the audience that, or telling the traders or investors that, we have no volatility. We have change of prices according to global money supply, whether it's M1, M2, M0, or M3. Could consider all these money supply. We have a relationship with Bitcoin and with so-called inflation hedge as a classes. So although it is sort of like controversial to say if inflation or if Bitcoin is hedging inflation in a long term or a middle term way, I still see that there is a lot of volatility. So right now, back on the chart, we can see the purple line is hitting a low, a relative bottom of what we saw in 2015 and 2019. So are we seeing a relative bottom, macroly in a week or in a month or so to compare to the global money supply year-over-year change? We have sort of like we have some clues, but we don't have a absolute answer. So this answer leaves to the audience, but we tend to see that this is relatively cheap. So it's so cheap that it's the RSI or the bottom out or the bottoms that it has a lower bottom compared to 2019 or 2015. So when we see at this price level, we tend to see that Bitcoin bumps out at a macro way. So what do you think about this? Sort of like global money supply, basic year-over-year change and basic chart. Johnny?
I think the reason why BTC is correlated to the global money supply is that when there is more money in the market around the globe, and we have to think about if the governments print more money and the money will eventually get circulated into the economy, people get the money to spend, people get the money to invest, and then the consumption of people's money will then be circulated into other people's income as well. And what people do with their income, they might deposit in the bank, they might hire a fund manager to help them manage their portfolio. And the money eventually gets circulated around the globe, and then some part of the money is also get circulated into the equity market and also some risky assets as people like to invest. And that's why we're seeing a correlation here. And it's very interesting that it now reaches the RSI, it reaches the lower bottom. It's a lower bottom, yeah. It reaches a low in the RSI of this chart, which represents a might be another buying opportunity here. But I don't think please be very cautious that not just by looking at the RSI doesn't mean that the bottom has already formed. We have to realize that the price can have the price can actually go even lower. The RSI doesn't mean that if the RSI it reaches the bottom, it doesn't mean that the price can go even lower. We are now trading at 22K Bitcoin, and definitely there is room for it to go down. If we look at CVDD and also other realized price, the CVDD indicator developed by Willy Woo, which I remember we talked about in previous episode, which illustrate the base the base price for Bitcoin, which is standing around like 15K to 16K, and actually there are some indicators that telling us that Bitcoin's price can actually go lower. So we are actually seeing some of the indicators reaching the bottom, which means that we might actually see a price reversal here. There's a possibility that it might happen, but we also have to take into account of the global macroeconomic and also some geopolitical environment, because environment changes, and we cannot assume that the other factors were actually the same when compared to the 2019, also 2015, the environment. As the environment and also conditions change, we have to get adapted to the changes, right? And that's why we have to think through the reasons why the Bitcoin price went through the cycle like that. We have to develop our reasoning, and also to delve into the logic behind the price action, and also study the demand and supply caused by other important factors, for example, macroeconomic factors, geopolitical factors, and market sentiment, and also cultural. All of these all sorts of things actually contribute to demand and supply of the market, and we have to pay attention to a lot of things, a lot of details. We can't just base on one indicator, but it definitely is helpful because it provides a insightful information, a piece of insightful information for us to make a better decision. So it is very interesting that we are seeing a RSI bottom here, which we can just take note, and then we can move on to other indicators to reveal what other indicators are telling us. And then after that, after having a more complete and also overall view of the current market, and then we make better decision by then, right? So the next thing that we want to delve into here is that I will show you one of the indicators that we are now currently building is actually, we haven't named it yet, but we track the balance of, we check the important factors affecting the Federal Reserve balances. For example, we mentioned the TGA, the reverse repurchase agreement, and maybe mortgage-backed securities, and all these things which might affect the balance of the Federal Reserve balance sheet. We take into account, and then we made an indicator, and as we can see from the left-hand side chart, actually the blue line is the indicator. It shows the value of, we take into account the left assets, and then the Bitcoin average, we take into account the right assets, and then we are seeing a positively correlated relationship here. As we can see here, when Bitcoin, when the indicators has a pump here, and then the Bitcoin price follows, right? And then we're seeing another pump here, and then the Bitcoin price follows. The time frame of lagging is actually 1 to 2 weeks later. And then the indicator falls below, get a very significant drop, and then Bitcoin all the way down. A lot of things happened here. And then we are seeing, we're actually looking into the current situation, but maybe Dave, can you explain the leading indicator, the relationship between the leading indicator with Bitcoin and also SPX, because we are definitely seeing some correlation here, and but in the recent weeks we are seeing the correlation getting weaker, and there's some interesting thing we observed, and we are going to explain the reason behind.
Yep, cool. So these indicators are very amazing. If you're comparing the time frame between like the last relative bump, basically middle of 2021, to like basically when Bitcoin just goes down to like 18K, basically it falls nearly exactly or nearly the same as the leading indicator. So if we have this leading indicator, it helps our trades very much on the reacting with the market. So if we look at the right indicator, So basically, it's responding to the SPX, so at the S&P 500. So basically, the S&P 500 is also having a very sensitive, correlation, or very close correlation in a week two with our leading indicators. So what are these indicators? Basically, I think the audience is highly interested in. So basically, the left indicators is basically based on the Federal Reserve balance sheet, is the total balance of Federal Reserve, minus the the total balance sheet size of the Federal Reserve, minus the factors affecting the Federal Reserve balance, and plus the circulating money supply, or the money supply base. So basically, the balance sheet size minus what's the reserve that's holding inside the U.S. Treasuries, or the FR banks, or as a midterm or short-term holding, plus the money is going to the market. So basically, we can see that as a this concept as a net liquidity. So this net liquidity is basically like whether the Federal Reserve is tightening or easing, but basically when there is a result that they are tightening at a slower rate, than a much slower rate of the or much decreased level or decreased rate of sort of like the TGA or the money or the Federal Reserve factors. Basically, we can see that it is increasing. So when investors or traders know that there is an upcoming policy of tightening, so everything is going to go down. So why doesn't the market go straightly go down, or straightly go to zero, or go to S&P go to 2K? Basically, it's because there is sort of like a concept of net liquidity or remaining liquidity, on the market of the or on the Federal Reserve balance sheet, and what is happening on the market. They are correlated. They are having a sort of like a ratio of correlations. So apart from this indicator, if you look at right hand side, there's sort of like there is also a net liquidity, another net liquidity, leading indicator. So what this indicator shows to the audience is that this is basically the formula of Federal Reserve total balance sheet size minus the TGA account, and also minus the repo. So let's say if we have sort of like Federal Reserve balance sheet decreasing, tightening, like from 100% to like 95% interweek. So if we tend to have a TGA account sort of like reducing only like 1%, only 2%, compared to the 5% decrease, we still have a lot of liquidity, out to the market comparatively to the last, a week or last month. But if we said that we have a quantitative tightening, of 5% reduction of this month or this week, but we have a TGA of increase, like 20% or 50% or 30%, we have only little of liquidity, or remaining liquidity, or net liquidity, what you call it. But it's sort of like it tells the relationship of what is going on with the remaining liquidity. If the remaining is going up with the liquidity, the market is going up. Has that sort of like probability or tendency. So if the remaining liquidity, after the considering the Fed balance sheet size, and also TGA with repo, we're going to have a go down of the market phenomenal, of the S&P or risky asset class. So based on this chart, these two charts, we can also see that these two assets, S&P 500, sort of like and BTC is even reacting more than the S&P 500 compared to the sort of like indicators and Federal Reserve balance sheet tightening and a lot of stuff. So there is the third point is that there's an interesting point that the tendency there is a closer relationship, or this indicator may not probably may not be working as well as previous sort of like period. It is because like the Federal Reserve is sort of like ending tightening, or they just started tightening, but the market expects the finish or the completion of tightening policy, or what we call it, the market already priced in the Federal Reserve tightening policy. So if they change this rule, that means the market already priced in or a rate hike or a tightening or they like 9% or 95% priced in, we sort of like see this indicator may not be working as well as previous time frame. But what we want to tell our audience is that even though we don't have, maybe they have priced in, I mean, the market has priced in with the, Federal Reserve rate hikes and the Federal Reserve, tightening policy, but, somehow, maybe there's an expectation or a prediction or a probability that, the Federal Reserve is going to print money again to save the economy. So no investment advice. Also, I also learned it, from the market, at a daily basis with the, central bank policy and monetary policies. I don't have an absolute answer to whether the Fed is going to print money again, but it's very highly likely that the Federal Reserve is going to have a similar strategies when economy is going to go down. So if there's a similar case in the future or in the coming future, I think the audience can have a takeaway or have similar strategies to react or to pre-react with the market. So what do you think about these indicators or the market phenomena, Johnny?
We are definitely, benefiting from using these indicators because these indicators help us, get more updated with the market so we can react more efficiently and also effectively to market changes. And what I already mentioned, we also have taken account of other factors. We have to think through why the leading indicator is maybe having a weaker correlation right now with the risky assets. We have to think about a reason. Is that because the market participants already priced in the effects of quantitative easing, quantitative tightening, and the demand stepping in, and also some market sentiment changes, maybe reflected by some yield curve and also other indicators. So this is not the whole picture here. This is just one piece of the picture, and we have to put the puzzles together to get a overview of the market so that we can position ourselves at a better place in the market. And we've done talking about indicators. I hope you guys will stay tuned to our weekly market chat, because next week we'll be we'll be showing you guys some work that we have done on building the indicators. So but right now we want to talk about the Ethereum merge and also Ethereum fork, because we all know that Ethereum is expected to merge in late September if there's no delay. So right now, a lot of projects, DeFi projects, are built on the Ethereum chain, and right now the developers have to take sides whether after the merge we have Ethereum fork, like Ethereum 1, which is based on proof of work, and also the Ethereum 2, which is based on proof of stake. So different projects have to take sides, right? Some people like using Ethereum 1, which is based on proof of work, while some people like proof of stake. And I think we are seeing a very interesting situation here, because actually we have not seen cases like that. So you might say that we had Bitcoin Cash before, but this time is different because the Ethereum ecosystem is actually very big now, and there are a lot of actively using projects and also developing projects, especially in the DeFi industry, with a lot of useful projects built on using the Ethereum chain. And that's why we have to be very we have to pay a lot of attention to whether these projects will take the Ethereum proof of work or Ethereum proof of stake. So I think actually I talked to Dave before, and Dave said we should also pay attention, be aware of the decentralized consensus of these projects, because ultimately what we want to cherish in this industry is that our community matters the most. Actually, our community powers the whole ecosystem, so that we need to respect the community's decision, so that we need to vote, right? And Dave, what do you think about voting? should projects have, the decision made by their community or the developer has a larger stake in, deciding whether to stick with Ethereum proof of work or Ethereum proof of stake? What do you think about it?
Yep. So I think you made a very good point that in this decentralized Web3 way, so our community, should have the choice of whether we're going to if Ethereum, proof of work or proof of stake. But what we see now is like most people are willing sort of like more have a sort of like more tendency to go to proof of stake system because of lower gas fee, so we have a better production rate. But more I mean a part of people are still like if proof of work maxi, so when they also want to choose to proof of work, they should have a choice and they should have be should have respect from the community. So what I see from the Ethereum fork is like the proof of stake is going to happen on the data availability layer and consensus layer, but the execution layer is still going to remain the same as proof of work. So probably if you're developers, you are going to get used to proof of work, and you get used to proof of work, and you're going to stay with the proof of work on execution layer. That means the smart contract layer, bridge layer, and protocol build up layer, that stuff. So yeah, basically that's my opinion.
Yeah, cool. So currently the market and the community around the Ethereum is not very decisive about whether to stick with Ethereum proof of work or Ethereum proof of stake because it's still early. So we have to stay tuned to the market and the market sentiment. We have to explore a lot of communities comments on whether to take which side on Twitter, and let's see how things develop. And we are going to update this Ethereum fork with you guys next week, probably. And also weeks later, we are going to see how things develop so that we can know what's happening in the space. Keep you so we can keep you updated to the market. Last but not least, we have the X Research DAO. We just found this last month, and then we are very excited. We are very excited to announce that this X Research DAO is actually a decentralized autonomous organization backed by Huobi Research, and we are going to publish a lot of nutritious and also insightful research paper for you guys to learn what's happening in the space. And what I want you to do now is to join our Discord because we are growing our community on Discord, and also make sure you check our Instagram, not Instagram, our Telegram, and also follow our Twitter. And I will see you in the Discord and also Twitter. So lastly, we have the candy drop event. I think most of you anticipated this event for a very long time. And make sure you are on Huobi app, and also make sure you have 100 USD trading volume of any asset in the last 3 days. And then make sure you register for the candy drop event so you can win up to 100 USDT. So we have also the double up coupons for the winners, so that one lucky star will be elected to get 1,000 USD. So that's very big reward. So make sure you get you trading on Huobi app spot account, and I wish you good luck winning your reward. And lastly, we'll see you next week. We'll update you with our powerful indicators, and also we'll update you news that are happening in the space to keep yourself updated. And thank you for listening. Follow us on Twitter, Huobi Research, and yeah, see you next week. Cheers.
Cheers.
Bye.